Module 2. This module is going to consider basic financial systems and institutions. We'll be pulling from chapters 4 and 5. As you can tell from this slide, there are a number of types of financial markets. This slide includes 10 of those financial markets. I want you to recognize that sport does not encompass all of these markets or is not represented in all of these markets. However, I want you to recognize that even though the sport is a business, there are a number of markets it will not trade in or be found in. But just for the record, some types of financial markets are tangible or physical markets, financial asset markets, spot markets, money markets, mortgage markets, primary markets, futures markets, capital markets, international markets, and secondary markets. Again, a number of these, such as tangible or physical markets, financial asset markets, capital markets, we will be dealing with in sport. Let's take a little further look at understanding financial markets. It's important to note that when businesses are seeking to increase funding or to raise funds, they are not required to use only one market. And it's actually more common that businesses seek to use several markets when raising capital. Regardless of the market, though, it's important to know that there is one common denominator across all financial markets, and that is this concept of money. What is money? For us, money can be dollar bills, cents, or maybe even viewed from our bank account or credit card. And for Americans and most countries, money is simply the means by which commerce can occur. It needs to be noted that money has no value in and of itself. Simply, it's just a piece of paper or metal. What is valuable is the agreement between the two parties that place a value on the item or market. Again, if we think about if a piece of paper, even a car, a home, the stock market, stock in a company, all of those things in and of themselves are invaluable or they have no value. What makes those items valuable, home, car, stock market, those types of things, is the value that we as contributors to the market place on that item. Let's look more at the practical sense of instruments of commerce and ways that we can go about conducting commerce. Over time, because of where we have gone in commerce, it has become necessary to find other instruments outside of, we will say, dollars and cents to be able to conduct business. Think about how difficult it would be to conduct business in other parts of the country, distribution centers, if we always had to pass simply dollars and cents. So yes, we do use money as a way to institute commerce, but we also use things like credit, we use checks, we also issue securities. Those are those ideas that a company has value by its stocks and bonds. We'll look a little more in this in depth as we go. Let's recall that this module is a consideration of basic financial systems and institutions. And one of the key concepts surrounding financial systems and institution is this notion of assets. So let me ask you, what are your financial assets? Some of you may say, well, my car, my checking account, maybe a stock or bond that my grandmother gave me, and those types of things. Similarly, businesses also look as to see what their financial assets are. Two ways to think about this. One, first, liquid asset. This asset is one that is easily converted to cash. We think about those as securities. A couple of examples may be kind of shorter maturity periods or T-bills, stocks that are sold on a daily basis, or these kind of relatively risk-free bonds. Those are often government-issued bonds. For you, your liquid assets might be your checking account or your savings account. Those are the items that are easily and quickly accessible. Those are your liquid assets. It's quick cash. Hard assets, or we'll just think about it this way, they're harder to convert to cash quickly. So for example, your car may be an asset, but in order to get it to cash value, it takes a little time. Other companies have those hard assets as well. Those things are things such as real estate, machinery, factories, and so on. This slide helps us look at that kind of basic financial system. First of all, what are stocks? And then secondly, what's a bull or bear market? First of all, a stock is simply a certificate or a document demonstrating ownership interest in a company. For example, do you have stock in, say, AT&T or maybe Lululemon? Some people have stock in Google, which we have learned is very profitable. So what's a bear market? A bear market is a stock market in which investors are scared and therefore prices drop approximately 20%. We have seen this in the US in some instances where investors are scared because of the state of the market. We've seen crash, recession, and depression. A bull market is the opposite. The investor wants to be a bull, or think about bullying their way. So a bull market essentially occurs when investors are optimistic and the stock market increases. Again, so two simple ways to think about it. Bear or bearish, you can't bear it, and so you don't want to invest, you're scared. Bull market, on the other hand, you want to rush in, and therefore the stock market increases. I think those are two easy ways to help kind of remember those concepts. Let's talk briefly about bonds. In the instance of bonds, there are two parties involved: the debtor, or the individual issuing the bond, or the organization. The other side, or the other party involved, is the entity that purchases the bond. It should make sense that the greater the company's financial strength, the easier it is for the company to issue bonds. That is, that company has greater leverage in order to do so. Bonds are typically infrequently seen in the sport industry, but they do exist. And here is an example. The New York Yankees and the New York Jets merged and undertook a bond offering through what was called Yankee Nets. They raised approximately $250 million. This bond issue, or this money then, was used to help purchase the New Jersey Devils. Therefore, the debtor, or the entity issuing the bond, was Yankee Nets. The creditor, or those entities purchasing the bonds, were all of those individuals that then bought rights or bonds in this, helping raise this $250 million that ultimately became the New Jersey Devils. Two very important and powerful institutions in U.S. financing are banks and the stock exchange. Banks are common knowledge for us. They provide loans and facilitate economic growth. They allow people to put their money in and also allow check holders or checking account holders to issue checks. They provide clients with other services. They provide specialty savings account. They also act as general depositories for our U.S. Treasury funds. Without banks, we would have no holders, per se, of our money or resources. Stock exchange is where we exchange stock and value, and it's the platform at which these exchanges are owned and operated. We have three U.S. stock exchanges: the New York Stock Exchange, the NASDAQ, and the American Stock Exchange. You yourself will be doing a project regarding your stock project, and will be utilizing those platforms to exchange or to buy and sell stock. So how does buying and selling operate on the stock exchange? We have the ask, or the offer price. That's the price that the seller would like to receive for the item wished to be sold. The bid is the price that the potential buyer is willing to spend or acquire the item. Somewhere between these, a compromise is reached. I think this concept is most easily for us, in a simple terms, is able to see this idea of eBay. When eBay first entered the market, there's a product, we'll say a pair of shoes. Many bidders are attempting to indicate the price that they would be willing to pay, and ultimately someone wins the bid and therefore is then the owner of those new pair of shoes. Again, the three places that our stock exchange happens, the NYSE and the Amex, these are auction style types of stock exchanges with a floor. Think Wolf of Wall Street. The NASDAQ is buying and selling that's simply negotiated through computers, while the NYSE and the Amex are typically negotiated through brokers, humans, people. We have roughly three types of sport organizations: government sporting organizations, nonprofit sporting organizations, and as you'll see on the next slide and next several slides, those organizations for profit. So first, what's a government sporting organization? These are simply run by the government. They're government entities that offer the funding and facilities for sport organizations. We see this in park and recreation departments, oftentimes even high school athletic departments, community centers, some public college athletic programs, and numerous other programs are sponsored by the public, or tax dollars help these sporting organizations run and operate. It can be argued that even most sporting organizations throughout the world are owned and operated in some capacities by the government. Olympic programs in most countries are run by the government. So what's a nonprofit sporting organization? Also, a large number of sport organizations can be established and managed, under a nonprofit business structure. They seek to offer a service to the general public without seeking a major profit. So how is a nonprofit status given? It's given if the organization has a cultural, artistic, educational, and or other public benefit. An interesting one, and one that we've seen receive a lot of criticism, is such that the NCAA actually has a nonprofit status. It could be argued, though, that this is for, at the end of the day, college athletics has an educational mission in mind. Again, to be debated at a later time. As I talked about in the prior slide, we have three types of sport organizations. We looked at government sporting organization, nonprofit sporting organization. Now we are going to look at those for-profit organizations, or this notion of sport as a business. When we think about sport as a business under this for-profit structure, we have 5 types of business structures. We are going to break down all 5 of these structures in the next several slides. We are going to look at sole proprietorship, general and limited partnership, Subchapter S Corp, C Corps, limited liability corps, or corporate partnerships. I recognize that many of you have had general concepts of these types of business structures. For some of you, this will simply be a refresher. For others, it may be some new information. I want to try to point out what the type of business structure is, as well as its pros and cons, and I'll ultimately also try to give examples of where we see these types of business structures specifically in sport. We are now going to address those 5 types of business structures. As we progress through these, you should recognize that they become more convoluted and ultimately more complicated. Our first is sole proprietorship. This is a business owned by a single person. In doing so, there are a number of advantages in owning one's own business. The individual owner has total control. Those revenues are taxed only once. The individual owner has a great flexibility. They're easy to format, that it only takes one owner. The owner themselves retains the profit. There's less concern about confidentiality. Oftentimes it's easier to sell, and there's fewer government restrictions. There are, however, some disadvantages of sole proprietorships. If an individual that owns their own business They are the ones in charge. Therefore, there's sometimes limited managerial experience. There's unlimited personal liability. The individual owner is the sole person liable. They take on all of the liability. That sole proprietorship lasts only as long as the owner lives, and it has limited access to capital funds. Our example for as these types of entities, we'll call it Just for Girls Sporting Goods Company. If you, as an individual, have decided you want to start a sporting goods company called Just for Girls, you have a number of advantages in doing this. Again, you're the one in charge. It's fairly easy to get going. You make all the decisions. Some of the greatest disadvantages, though, come in that you are the only one involved. Therefore, the liability falls on you, and it ultimately results in limited access to funds. We'll see here going forward that as those businesses grow, oftentimes they become bigger, more convoluted. We see more partners involved. We'll continue to use our concept of this Just for Girls Sporting Goods Company throughout the next several slides. Our next business structure is a partnership. It is just as it sounds. There are two ways to think about it: general partnerships and limited partnerships. But in and of itself, it's as if the work is divided equally, or there's a division or ownership. These individuals are considered partners. A general partnership is when individuals or groups combine resources to share in all the operating, managing, and controlling, as well as the profits and liabilities. Limited partnerships is where one individual or one partner manages, or a smaller group of partners manage, and the others are simply financial partners. So let's go back to our Just for Girls Sporting Goods Company. If there are 2 or 3 friends that decide they want to start this sporting good company, we can ultimately create a partnership. In a general partnership, all members, say all 3 of the friends, are going to combine resources. They're going to share in operating and managing and controlling, as well as the profits and liabilities. That's a general partnership. If we have 3 friends and one of those friends is going to be the individual or that manager of it, and the other 2 individuals are simply going to back the company or partnership with financial resources, that is our example of a limited partnership. Both of these, general partnerships and limited partnerships, are common in various sport businesses, gyms, sporting goods companies, services, coaching services, and so on. So what are the advantages and disadvantages of partnerships? Because of the simplicity of partnerships, you should see that the advantages and disadvantages of partnerships are very similar to that of sole proprietorship. There's some control over decision making, revenues are taxed only once, there's great flexibility, easy to form, easy to sell, profits are retained by the owners. Disadvantages, again, similar to that sole proprietorship, is that there's limited managerial experience, there's joint personal liability, but still that liability is taken upon by the partners, there's limited access to funds, and this lasts only as long as the partnership survives. Can be argued that many partnerships have gone awry because partners have been unable to get along, thus the partnership dissolves. As we move into corporations, this is where we see business structures begin to get more complicated. The first type of corporation is a C Corp. It's essentially a fictitious legal entity where formulation complies with state-specific laws. It's simply also known as just corporation. So what is a C Corp? What can be done to develop this? There first has to be some development of bylaws and articles of the corporation that specify how they will go about conducting business. Some of those important areas include the corporate name, the number of shares that the corporation will issue, the initial address, and the name and address of each of the initial incorporators. The next couple slides will talk more about C Corps. There are a number of advantages of C corporations. Hopefully you're making this connection. We've moved from proprietorships to partnerships, and now as companies grow and expand, they often become larger corporations, or they become incorporated. Why? Often it becomes an issue of liability. No longer is the liability put on individuals, but rather there's limited liability to the extent of the corporation's assets. Creditors then cannot come after individual investors. Ownership interest also is easily transferable because we're transferring shares. Owners then can easily get in and get out of corporations. Because of the financial backing, it's much easier to have a broad base of talented managers. There's a tax benefit. Dividends are paid to corporations are 70% tax-free. We'll talk a little bit more about taxes in a second. Also, because of the backing of corporations, the financial backing that is, there's greater bargaining position within vendors who are willing to often provide credit to a corporation more willingly than an individual who is a sole proprietor or that single owner who takes on all the liability. Maybe one of the greatest advantages of C corporations is this ability to issue publicly traded debts and equity. If a corporation wants to build their equity or potentially get a more financial backing, they're able to issue those publicly traded bonds, debts, and equity in order to do so. We'll talk about disadvantages in the next slide. So what are the disadvantages of forming a corporation? After talking about those advantages, it may seem like a no-brainer. However, it needs to be noted that creating corporations have a complex formation process. There's an exorbitant amount of paperwork and legal work. In addition, different than a partnership or a proprietorship, there has to be a responsibility to shareholders. Furthermore, as we saw in proprietorships and limited partnerships or partnerships, there's little or less government regulations. Corporations have greater government regulations. Lastly, there's this concept of double taxation. The corporation in and of itself is taxed. Furthermore, if there's a dividend on the shareholders, that is also taxed. Please make this note that oftentimes individuals who incorporate or start a corporation often are shareholders as well within that corporation. Therefore, not only is the corporation itself, the business itself taxed, then that individual shareholder is also taxed. Our fourth type of business structure is a Subchapter S Corporation. In order to form a Subchapter S Corp, you must have up to 35 shareholders. It has to be a U.S. company, and they can own subsidiaries. We'll talk about that in a second. There's also under this tax-exempt S Corps. These are typically charities. And in these charities, individuals or groups can own shares. So what are the advantages of S corporations? First, the income flows directly to the shareholders. Shareholders pay taxes as personal income. Therefore, there's no double taxation. In addition, S corporations can own subsidiaries. In doing this, it helps insulate them from further liability. A couple of disadvantages, though, of these S corporations is that they cannot be owned by another corporation or partnership, and that they can issue only one form of stock. Because of some of the difficulty in forming C Corps and S Corps, limited liability corporations and partnerships have resulted. This is our last type of business structure. These business structures have some of the benefits of corporations and partnerships without some of the drawbacks of these typical corporate creations. So what are the advantages? They're classified as partnership for income tax purposes, which we know then single tax, not double tax. There's liability protection is afforded to that corporation. They can be owned by another corporation or partnership, and maybe the best advantage is they're easy and inexpensive to form. There are a couple disadvantages, though. Because of their newness, there is no national standard. Each state thus has unique rules and regulations, which can create some difficulty in these limited liability corporations and partnerships. Throughout our discussion of types of business structures, we've talked about taxes and cash flow a little bit. So let's give some basic definition to these concepts. So, tax basics. For someone who's involved in the managing of sport, regardless of the organizational structure, there needs to be some knowledge of tax basics. Cash flow. First of all, cash flow is subject to taxation. Obviously, as we've gone through those different types of business structures, what that looks like, or that taxation looks different. Cash flow. The value of any financial asset or instrument is contingent on the cash flow produced by the investment. If the tax rate on a given investment cash stream is too high, the investor will opt for a different investment that may have a lower return but also lower taxes. So what does that mean? There's an investment that has a high return but is high taxed, or that the individual investor has to pay exorbitant taxes on their return. That investor may choose then a return that has lower yield but lower taxes, because in the long run, they ultimately make more money. Okay, so in the previous slide, we talked a little bit about those tax basics and cash flow. So what are a couple of ways or formulas that we can determine this tax equivalent yield, and or ways that we can determine yield on investment? So two formulas, don't freak out, they're not horrible. First is a tax equivalent yield. This formula measures the yield of a tax-free municipal bond against other investments that might require tax payments. I'll give you that formula in the next slide. Our second one is a minimum municipal bond yield. This formula helps us determine the yield on that municipal bond, or YM, when we know the taxable bond yield. So it will help us determine whether it makes more sense to be invested in a tax-free municipal bond or another investment that ultimately would require paying taxes when a return is yielded on our investment. All right, we're back to those formulas for investments and taxes. Okay, let's talk through our tax equivalent yield. Our formula states that our tax equivalent yield is equal to our tax minus our exempt yield divided by 1 minus our tax rate. Okay, let's put this into context. If a business has a 28% tax rate and a tax-exempt municipal bond pays 5% interest, then necessary returns on a taxable investment would be that 5% divided by 1 minus that tax rate of 0.28 to equal 6.94%. So what does that mean? To maximize your investment return, you should invest in the tax-exempt municipal bond unless you can find another investment that has a return greater than 6.94%. Minimum municipal bond yield. This formula states YM, remember that's the municipal bond, equals TBY, remember that's the taxable bond yield, times 1 minus the marginal tax rate. So for example, here's our formula, 14.5% times 1 minus our 0.31 or 31% equals 10%. Therefore, a person taxed at 31% considering a taxable bond year with a bond of 14.5% return. Or in other words, such a person would want to find a municipal bond with a rate of at least 10% in order to match the yield of the taxable bond yield. So what does all of this mean? This gives us some tools and information to recognize where we can invest our money with taxes in mind in order to utilize and or maximize our investment. In keeping with our discussion on taxes, what are some tax issues in sport? First, how do taxes impact the industry or the sport industry? First, lease values. Are organizations required to pay taxes on their lease of facilities or the facilities in which they compete. Also, public tax dollars have been helping owners. This is a very controversial area. This issuing of tax-exempt bonds to sport franchises ultimately result in tax-free money for owners. Also, there has been some discussion on this taxing of, we will say, not-for-profit or nonprofit institutions, which are arguably educational institutions. We may even want to think back to our discussion that the NCAA is a nonprofit, therefore it's not taxed, which we all know can look very interesting. So, a couple of issues impacting sport or intercollegiate sport are the bowl games and this taxation of educational institutions. Therefore, do we force nonprofit educational institutions such as colleges and universities involved in bowl games to pay taxes on those bowl game revenues? Or do we have to have those institutions pay taxes when they receive $1 million from a title sponsor? These are issues and questions faced. Also for athletes. Athletes face a number of tax issues as well. They have to know how to categorize their income. That is, can we write off some of the expenses of athletics as tax write-offs? Also, it's important to note that there are tax issues associated with bonuses and business expenses. Tax rates differ across states. Note that some organizations, Major League Baseball, asks and requires that their athletes pay taxes in the various states at which they compete. All of that to say, tax issues in sport can be convoluted, but it's important that being involved in the industry, whether as an athlete or as a sport manager, one know some of those issues. In keeping with our tax discussion, it's important for organizations and businesses to understand depreciation of assets. This allows organizations and businesses to write off current expenses they've incurred. That is, think about this. Capital assets are expensive. It is expensive to upkeep machinery, facilities, and so on. Here's an example. If a machine costs $1 million and has a life of about 5 years, that company can write off depreciation of $200,000 a year because that asset the company owns in that machine goes down every year. That becomes a tax write-off. An athlete's salary in professional sport is the only type of salary that is depreciable. Note that. Okay, so there are some other capital assets that can be depreciated. The franchise itself might depreciate. Lease contracts, concession contracts, broadcasting contracts, and customer lists. All of those are depreciating assets or expenses that can be written off the year at which they incurred. Obviously, being involved in business is risky. Therefore, it's important to have in place some type of financial risk management. So what is risk management? It's simply the process designed to identify potential problems and produce solutions for risks that can range from tax concerns to litigation-based issues. Risk management is loss prevention or reducing loss. One of the ways we do this is insurance. It represents an attempt to shift risks associated with a financial loss. We have insurance, so for example, on facilities that if heaven forbid a natural disaster happens, it shifts the risks a sport organization would have in rebuilding a facility to the insurance company. Risk financing is designed to help settle a financial dispute after a loss has occurred. A couple ways to do this. It discusses or establishes who will pay, and it's ultimately a passive activity compared with risk management. Risk management is proactive. Risk financing, we could call it maybe reactive. Bankruptcy is our last concept for Module 2. It's essentially the technique used by sport businesses and all businesses when they face mounting obligations and do not have the resources to finance continued operations. There's 3 ways to file for bankruptcy, chapters 7, 11, and 13. For the most part, in sport organizations and sport businesses, in order to keep going, in these organizations file chapter 11. What does that do? It provides an outline for a formal business reorganization that's supervised by the court in order that the organization continue to operate. We've actually seen this in examples. Texas Rangers, the Cubs, the Dodgers, and the Sabres are all at one point were chapter 11 bankruptcies. Government came in, required that a formal reorganization be put into place in order and supervised by the court in order to get financial operations under control. There are a couple of protections that are key in chapter 11 bankruptcy. It includes an automatic stay, and what this does is that it prohibits continuation of any legal action against the business. Probably that is one of the biggest areas or reasons why organizations file for chapter 11. And we have come to the end of module 2, where we've discussed basic financial systems and institutions, again covering chapters 4 through 5. Here are your questions for thought. Use these questions as a way to fact check you, go back through your understanding of materials as well as application.